Thank you for joining us tonight for United Policyholders webinar on taxing matters. Today, we're going to be talking about non-FEMA declared catastrophic loss events and how that relates to your taxes and insurance. To download and follow along the slide deck, please go to our uphelp.org. Under events, go to this shortcut, and you will find, as you see highlighted here with the arrow, a PDF of the deck you can download to follow along. A little bit about United Policyholders. We're a national nonprofit based in California that have been operating, helping consumers post-disaster since 1991 Oakland Hills wildfires. We our focus with our Roadmap to Recovery program is this post-disaster guidance and services, helping you in this insurance and insurance adjacent decision-making work that you're doing. We are funded exclusively by donations and grants, supported heavily by pro bono volunteers and community volunteers. And we partner very heavily with other nonprofits such as your VOAD and your long-term recovery groups, and other state and federal agencies and trade and professional associations that are operating to help serve you. United Policyholders is made up of very small professional staff of about 15 folks. We've got staff in multiple states across the country. As I said previously, we partner very heavily with government and our nonprofit partners. And one of the unique things about us is our team up volunteers. We have both those consumer focused professionals, such as attorneys, CPAs, financial planners, public adjusters, construction and real estate professionals. But we also have our previous catastrophic loss survivors, such as John, who is with us today in his professional capacity, who want to share that hard-won knowledge with you and help you navigate this process. We have our 3 programs. Today's workshop is on the Roadmap to Recovery. Our Roadmap to Preparedness takes those lessons learned, what people wish they had known pre-disaster, and helps educate households and communities to reduce risk and become more resilient to disasters in the future. And then our Advocacy and Action program is where we take those issues that people struggled with collectively and fight for improving insurance consumers' rights and protections. For this event specifically, this is your disaster recovery help library. Please check this out if you've not been. Our website has a wealth of information to help you, including samples and examples, a step-by-step guided resource, a library that walks you through what you need to know and when you need to know it. And then our Survivor Speak article series that's online. In addition, you can also follow upcoming events. We will be doing a workshop for you in March. More details will be coming out on that soon. Fine print, this workshop is intended to be general guidance only. We are not providing legal advice. Our speakers are volunteering their time as educators. And if you have a specific legal or professional question, we recommend that you consult an experienced professional in that space that you need the question. We are not able to serve in that capacity for you. Our purpose here tonight really is just to get you a good understanding of what insurance and tax needs are as you're navigating this space so that you can make good decisions and you're aware of what you need to know moving forward. So today's presenters, myself, I am the program specialist for United Policyholders. I'm based down in San Diego. And with me today is John Trapani, CPA. And John is, he's licensed in California, Colorado, and Hawaii. He is a disaster survivor, as I said. And John, I will let you introduce yourself and your background a little bit more.
Good evening, everybody. Thank you for joining us. My background goes back to 1967 when I entered the profession, but my background with regard to disasters mainly started in 1994 with the January 17th, 1994 Northridge earthquake. It was both professional and personal. Our home was located about 1.5 miles from the epicenter. I had a good amount of time during the year since the disaster happened at the beginning of the year to get educated, because I really did not have a lot of understanding of what was going on, what was required, and I knew there was something was required to be done, but I didn't have a good understanding at the beginning of that year. And so I found mentors and researched and, like I said, spent a lot of the time during that year educating myself so that when the end of the year came, I was ready to assist myself and also to assist other people. And it just became a process because of the drawn out process that many of the people had with the Northridge earthquake. It took a number of years for some of the people to finish up their reporting. And then all of a sudden there was a new disaster and then another disaster. And finally in 2017, I realized that this was probably the best way to spend my remaining time of my professional life was concentrating on disaster income tax reporting. And in fact, at the end of the 21 tax season, I disengaged from all of my normal or regular, quote, regular clients to concentrate 100% on just disaster income tax reporting. And that's what we've been doing in the office ever since.
Well, John, thank you for joining us today and for sharing your time as a volunteer. I know some people are just coming on and joining us now, saw the event and signing up. So just a reminder, this workshop is for non-FEMA declared disasters. If you are from LA specifically, this is not the workshop for you. We are not talking about that piece. There will be a workshop for the LA fires coming up soon, but this is very specific to mountain and park fires. So just to be aware of that, if you're joining us in real time and you missed that at the beginning, that is what this workshop is about. So I am going to start with getting yourself organized. Just as we say with any insurance claim work you're doing, keep that claim recovery journal, document everything, save all your receipts to keep things simple for yourself, especially when you're getting into the accounting for tax purposes. Consider opening that separate bank account for your insurance funds received and asset replacement funding so that you're able to track very easily what you received and how you spent it. One way to keep yourself organized is just setting up that special email account for your claim that your correspondence with your adjuster, any of the professionals you're working with, everything goes there so it doesn't get drowned in your normal daily life. Make sure you're documenting and tracking not just all those insurance communications, but with your builders, everyone you're working with. And one way to track your expenses and the money matters, we have a CPA from the Woolsey Fire who created for us this insurance accounting spreadsheet you can download here. It's a really good way to go ahead and make note of what your max insurance proceeds are and then track every one of those checks you have coming in so that you know when you're at policy limits and you're able to help keep yourself organized. So the goal of today's presentation is to help you understand tax compliance requirements and benefits available for you, households that experience a catastrophic fire loss, but without that major FEMA disaster declaration, and make good financial decisions, including when to file, timelines for reporting, what your tax-related options are for insurance claims, what an involuntary conversion gain is, and why you need to consider getting professional help. This is just a breakdown of the subtopics we're going to talk about: how disaster impacts your taxes, episodic reporting, important tax terms, annual reporting, time limitations, filing extensions, and some other considerations: tax treatment for ALE, purchase of a temporary home with additional living expense funds. Let me define that. Business losses, if you had a second home, what those tax implications are, and the same for rental property. What are those tax implications? Prop 19, just to call this out in this early section before we get into the nitty gritty with John. This was enacted in 2020 as a ballot measure, and it provides a significant property tax savings where you can transfer your property tax base of your existing home to a new home anywhere in California without a price restriction. So it just gives you the option of what was previously allowed for people who were 65 and older or disabled. Now, victims of a wildfire or natural disaster also have that protection in this proposition. And John, I'm going to start with the common tax questions we hear. And I know the answer for most of these are, it depends. But I'm going to poise them. And if you want to add just a little nugget to
Sure.
anything I say, please do. I know we're going to dive into these in more detail. Are some or all of my insurance proceeds taxable?
And not likely. Most of them probably are not taxable.
All right. Will my insurance company send me a tax document?
Like a 1099? No.
Okay. How can I have had such a devastating loss and have my insurance proceeds be considered a gain?
Yeah, this is the big question. And we'll get into this more, but it's a matter of how long you've owned the house and how much you have it insured for. So if you bought the house maybe 20, 30 years ago, you may have a very low tax cost basis. You may have bought the house for $300,000, and today it might be worth $1 million, and the replacement value or of the house might be, just the house itself might be $800,000. So as far as the tax law is concerned, you've got a $300,000 asset that you sold to the insurance company for $800,000, and there's a difference there which starts off being considered a gain.
All right. And I'll touch on the others that we'll talk about in some detail in a minute. Are there tax exclusions available? Yes.
Yes.
If you're underinsured in one or more categories, can you offset the losses on your tax return?
Unfortunately for these two fires, we will get into this a little bit more, but the answer is no.
All right. Are litigation proceeds taxable?
It depends on
All
what
right.
on what you're being compensated for.
Right. So if there's litigation, it'll depend. And then we'll talk about this one. What tax considerations are they if they sell the lot without rebuilding? All right. We're going to jump on a tax relief. Timing matters. While all of this is new, you're dealing with an awful lot. It's easy to ignore the need to deal with the tax reporting of the event and resolution. However, tax reporting is part of the recovery process, and the tax code provides opportunities to save taxes now and in the future. I want to call out that the notices you see on the IRS website, that link is below, with extended deadlines do not apply to Parker Mountain fires. You can file an amendment if your circumstances change. You can file for an extension, but you do not automatically have that extension to October 15 of 2025.
Correct. Unfortunately.
Yes. And then how do you find copies of your prior tax returns? Start with your CPA, your bookkeeper. If you use an online filing service, they should be able to provide you the records. You can submit Form 4506 to obtain copies directly from the IRS. And the IRS has information, if you go to this link here, on how to reconstruct your records after a disaster. It's very useful. Because you are going to want that information as you're looking at your tax basis and all of the stuff that we're going to talk about here moving forward. Just a quick dive. The purpose of the tax rules, really, it's just to collect money for the operation of the government. And you just need to understand everything you receive of value has a tax consequence and is taxable unless specified in the tax code. In a disaster situation, the tax code is reversed a bit. To take advantage of those rules in the tax code, that's where you have to have that major federal disaster declaration. It would be an event that starts with DR. Both Park and Mountain were fire management assistance declarations, so you might see that they were FEMA declared disasters, but they're not a major disaster declaration. FM does not, it's not relevant here. And so these are, if you've seen them, you can see that the coding here is they're FM 5519 and FM 5545. And so they're not eligible for those things that you're hearing about a lot right now with the IRS.
But there still are benefits, some benefits available.
Right. It's just knowing which apply to you, which is why it's important that, that's why we're doing this workshop, because it is complicated and it is confusing, because it feels like messaging is not as clear as it could be. So in what tax year should you claim a loss? Generally, losses can only be deducted in the year which the loss occurred, and all claims for reimbursement are settled. And so for
Now, the unfortunate thing about the park fire and the mountain fire is because they were not declared federal disasters, the DR code, pursuant to the 2017 tax law changes, casualty losses that are not part of a federally declared disaster, i.e. mountain and park, are not deductible for federal purposes. They're still deductible for state purposes, but not for federal.
right. And so there's no possibility of claiming that casualty loss for them for personal losses, only business or rental losses.
Business and rental losses are still available, yes.
Right. And then for the state casualty loss deduction, that's Franchise Tax Board Publication 1034. And so just keeping a note of that piece. And so we're going to start with, do you have a federal non-deductible casualty loss or involuntary conversion gain? And I know the terms are complicated, John, but if you'll dive us into this. So we're starting with the cost basis. Have the proceeds you've received or expect to receive exceeded that cost basis of the home you've lost? If they don't exceed the cost basis, you may have a federal non-deductible casualty loss that would only apply to the state, right?
Right.
If they do exceed the cost basis, which is most likely, if the property is appreciated, you have what's called an involuntary conversion gain. And this is the chart that shows the two paths here. And then, John, what do you need to know now? So we've got consider filing an extension before the deadline to file for your 2024 return, because you do want to file timely and report what you know. Maintaining all your records, insurance proceeds, costs expended to the event, document everything, right? And the first stage, documenting the cost basis for real property. So the next step is to document and preserve for later the cost basis of your home, your real property. You need to determine a reasonable good faith computation of what was your cost basis at time of loss. How much you paid. You can be looking at your tax records, ask your realtor, check with Zillow. If you have plans, if you don't have records that help support that, you can get a bid on what was built at time of construction, minus code upgrades, and then depreciate it. If you have an adjuster's report, scope of loss, you want to make sure those details are correct. You're going to also add to that home improvements, additions, enhancements. Those improvements could include landscaping, trees, other structures. It's not just the remodeling. Anything to add to this, John?
No, but also, unfortunately, because this is not a federally declared disaster, these rules also apply to the personal property, the contents, that you lost in the fire, and that's a little bit tougher. And there are some easier ways to compute things like cost basis, which is not necessarily the cost basis, but it's an acceptable substitute for the cost basis. Presumably, you're going to have to submit a document to the insurance company coming up with details of your contents losses, and that detailed document is a good starting point for coming up with a kind of an as-if cost basis for the contents items. And there most likely will be a gain if you've got replacement cost coverage on the contents.
Thank you for that. All right, Sage,
But I should mention,
yes.
but again, that is also subject to deferral, and as long as the proceeds, if you have a gain, if the proceeds are reinvested in other contents, type personal property items.
All right. And stage 2, identify and document your insurance proceeds. So you're going to track all your coverages. That goes back to that form we give you. Dwelling, ordinance and law, landscaping, trees, debris removal, your extended replacement coverage, other structure contents, scheduled property, your additional living expenses. If you do purchase real property, like a replacement home or a temporary home with your additional living expenses, you need to track that expense purchase as well, because it could lead to a taxable gain. And that documentation can include your settlement letters, copies of the checks, statements from your insurance company. And stage 3, documenting your recovery costs. Your goal is to capture all the costs of rebuilding your home or purchasing a replacement home and the cost of replacement of your lost personal property. So if you're rebuilding, you're documenting contractor costs, permits, fees, architect fees, required testing such as soils, engineering, etc., all of those pieces. If you're buying a replacement home, it's not just documenting the purchase price, it's also the realtor's fees, inspections, required fixes for your loan, etc. And the reporting, as you said, John, the reporting for contents is similar and separate from the real property reporting.
Correct.
All right. And this question is, why does it matter that our disaster is not a federal designated disaster? And it really is, it just focuses, it impacts your cash position and your tax options. So insurance proceeds and grants gifts specifically designated for contents damaged or destroyed are potentially an involuntary conversion gain. Contents losses can be considered when calculating deductions for casualty losses. This is only on your state return, not your federal. And remember, without that federal disaster designation of DR, the insurance proceeds you collect for contents are reportable and may or may not be taxable. All right, now which payments may be taxable by the IRS? And these are, regardless of disaster declaration, taxable reimbursements include unemployment compensation. So if you're participating in that EDD program, that would be reportable. Payments for real estate can be treated the same as if they're proceeds paid by the insurance company. John, I'll let you explain that in a minute. Some ALE insurance proceeds, if used to purchase that asset, like a real home, then rather than paying for temporary living expenses, may become taxable. And some of those insurance proceeds related to contents.
Okay.
All right. Non-taxable payments proceeds. That may include insurance proceeds for additional living expenses to the extent they are being used to pay for those recurring additional living expenses. So if you're renting a place, you're incurring mileage for being out of your area, all of those would be non-taxable. And then payments from social welfare agencies, charitable organizations, so grants, donations you've received, in-kind services and donations, none of those are taxable. All right, John, I'm going to take a deep breath because I've been talking too much. All right, now it's your turn to talk. So how to determine the cost basis for IRS purposes. So the slide says the purchase cost or inherited cost is used, not the market value, fair market value. Certain upgrades and additions can add to the cost basis. Integral nature rule for personal use real estate. This is land, fences, home combined, can be combined and added to your cost basis. So that's a little Greek to me. So can you add on to
Sure.
that?
So let's start with the purchase of the property. So whenever you purchase the property 2 years ago, 5 years ago, 30 years ago, you would have gotten a escrow settlement statement as part of the closing documents. Unfortunately, those are often maybe lost, or sometimes but if they're not lost, they're probably stored at home and may have been lost in the fire. There are alternatives to getting that information, unless the house was bought maybe 60 or 70 years ago. But if it was in the last 30, 40 years, an alternative is that we find is a reasonable cost basis of the house would be. We can find that on Zillow, Redfin, things like that, for Realtor.com, and they're usually pretty accurate. There's certain things that I've found in certain circumstances where people have had maybe bought a house back in prior to 1996, that there may be some adjustments that maybe are showing up on the Zillow numbers that are not accurate. But once you buy the house, now you're making changes to it over time, and some of that stuff is maintenance, and some of it is improvements. And so the improvements are added to your cost basis. So if you remodel a kitchen, that is part of your improvements. If you put a new roof on the house, that's an improvement. If you plant a lemon tree, that's an improvement. Unfortunately, petunias and annual flowers are not considered improvements because they get rotated every year, so they're considered a maintenance cost. But if you bought a house that had a terrible yard and you replanted the grass, that would be an improvement. And so all of these things get added up to come up to your cost basis of the house as of the date of the loss. And Val mentioned the concept of integral nature. When we're talking about personal use real estate, the IRS takes the position, which is good, that your cost basis is the total package. There's no need to allocate between land and improvements. The IRS, and and I know, and Val knows that when the house burned down, the land was still there. So, but there's no need to try to figure out what was the cost of the land and separate that out from the cost basis of the property. It's all just one big package. Now, if we're talking about a rental property, those in many cases are actually a lot easier because you've got a depreciation schedule on your tax return, and that would be the basis for the loss. And in that case, the land is not included as long as you have an intention to rebuild the whole the rental property. And we'll talk a little bit in a bit about when we sell the lot. Before we get to that, just we would on the rental property, we would be using the depreciated cost basis of the improvements. So it's a lot easier to come up with a gain on rental property than it is on a personal use residence, because one, we're not including the land cost, and the improvements have been depreciated. So your cost basis is probably maybe fairly low compared to the insurance proceeds that you receive. And so that puts you in a gain position quite quickly. Did I cover everything?
You did. Thank you, John.
Okay.
All right. Our next question is, if I'm underinsured, do I automatically have a loss for gain purposes? And you've kind of already alluded to that a bit. And the answer is, as you said, no, because you may have actually had a gain in the IRS's view because you paid less for your home than the amount of your insurance dwelling claim payment. And the only, you'd have to have that federal disaster declaration to be able to claim the casualty loss on your tax return. And regardless, you may be subject to a gain if your insurance proceeds payments are greater than the cost basis, as you said. But there are ways to offset or convert those gains.
And the thing is, you may have been really smart in terms of getting your insurance. And you thought, cost per square foot, you've really got a high rate of cost per square foot. But it turns out that with all these fires that we're having and the shortages of contractors, materials, et cetera, that the costs of reconstruction are just going up constantly. I've heard, I don't know about the mountain fire, but I've heard with the Palisade fire that the cost estimates per square foot are topping $1,000 a square foot. Back in the time of the Woolsey fire back in 2018, we saw that the cost without the fire, before the fire, was probably about $375, $400 a square foot. And because of the fire, the shortages, et cetera, that the cost rose to maybe $500 or $600 a square foot. Now we're seeing that $600 foot per square foot rise another four or $500 and topping $1,000. So you
Yeah.
may have had good insurance, but you still could be short in terms of being able to rebuild the house.
Right. And on that, just, to caution everyone, part of what you have to do in this space is looking at what do you actually have available to rebuild, and checking with, contractors, to see, getting multiple bids, because right now there is that surge, as Sean's saying. It may be that that settles down a bit, or it may not. It really just it depends. And so part of that homework of finding someone that can work within your means, or having a plan to be able to bring in other dollars, because this disaster did have the SBA designation, so that there are additional funds available.
And that's an interesting point that you allude to. The SBA, separate from from FEMA, will often have its own disaster declaration, but that does not qualify for purposes of the tax law to open up the special provisions in the tax law for disasters.
All right,
But it does open up FEMA's ability to make low interest loans.
got it. Thank you for that. So getting to, do you have a casualty loss? If you have one, it's only going to be applicable for the state. And again, probably not. It's very rare that this is established and documented if you're insured. But again, as you were saying earlier, it's good news, because that means you were more adequately insured. And there are other provisions of the disaster tax code that can be an assistance. And so a personal casualty loss, this is the lesser of, and this is again for the state of California only, the cost basis of the damaged or destroyed property, or the decline in fair market value, using before and after the casualty event, reduced by all insurance reimbursements, payments, and proceeds. Anything to add to that, John?
Well, yeah, the fair market value information, basically they're looking for appraisals prepared by qualified licensed appraisers, not realtors' estimate of value. And the appraisals are kind of weird in a sense, because they're about a nanosecond apart, a nanosecond before the fire and a nanosecond after the fire. And the importance of that is, one is the value before the fire is that appraisal is pretty much the appraisal that an appraiser would do if you had been trying to sell had been in the process of selling your house before the fire. The one after the fire, there are certain adjustments that need to be made. And I'm not going to go into the details right now, but there are some adjustments, some that will increase the fair market value and some that will decrease the fair market value. And then the difference between those two appraisals is the decrease in the fair market value. And it's the decrease in fair market value compared to the cost basis of the property that determines the lesser amount which becomes the basis for claiming a casualty loss. But then that's whichever number that is also then reduced by the insurance proceeds for the real property.
All right, thank you. John, as before we jump to form 4684, a question in the Q&A. The gain, is it income tax or capital gains? It is capital gains, correct?
Hopefully it's neither. Hopefully you're making an election to defer the gain because you're electing to replace the property. So you're making an election to rebuild and spend those proceeds on rebuilding the property. And if you do that, then the gain is deferred and rolled into the cost basis of the replacement property. And so you don't pay taxes immediately, but you might pay taxes sometime down the line. It's years from now, or if it gets passed on through inheritance to the next generation, well, then the gain gets just disappears.
All right, thank you. And so let's go ahead and jump to form 4684. So if you don't have a state casualty loss, you don't file form 4684. It's not relevant for the federal return because you're not eligible for that. But the state of California uses the federal forms, which is why it might be relevant if you had a casualty loss for your state return. And then while this is the only form the IRS provides for disaster taxes, there is another publication, 547, that explains that if you have a gain, you must provide a statement and attach it to your return with all circumstances reported, and that's 15 items to be precise. So it's important for you to understand, just because there's no form for it, doesn't mean you don't have to report something. And John, in your words, this area is so complex that the IRS cannot even provide a form for reporting.
That's true. And the other side also is that if you do have a gain and you're deferring the gain, you definitely do not want to use Form 4684. It is not designed at all to defer the gain. If you come up with a gain on Form 4684, you will pay taxes on it, and you should not be paying taxes on it. You should be deferring that gain and using that money to rebuild. And that's basically the concept of the involuntary conversion deferral, is that the IRS, the Congress is saying, we don't want to take your money and have you pay taxes on that. We want you to use that money to actually rebuild your life and your property.
Right. Rebuild, replace. Yeah.
Right.
Yeah. Well, we're going to talk just a little bit more about the casualty loss, just to make sure we finish with that topic. How to substantiate a state casualty loss, similar to what's required for insurance companies. You must be able to show the following: type of loss, date it occurred, that the loss was a direct result of the casualty event, proof you own the property, or if it was leased property, you were contractually liable for the damage. Whether a claim for reimbursement exists for which there is a reasonable expectation for recovery, and then documented evidence to support that claimed loss. Determining the amount of the loss, again, appraisal method, cost of repairs method with receipts, subsequent receipts backing that up, safe harbor computations. Two things of note here. The year to deduct, it would be loss sustained or prior year only on the state tax return. And the loss cannot exceed the cost basis less insurance proceeds.
And the important thing here is that you do not want, or technically you're not permitted to claim a loss as long as there are unsettled claims for reimbursement. So you don't want to, if there's any kind of lawsuits involved, you shouldn't be claiming a loss yet. If there's unsettled amounts with regard to insurance proceeds, you don't want to claim a loss yet.
All right, thank you. And so this is just I think a capper on what information is needed to report that state casualty loss. again, cost basis, insurance or other reimbursement, as you said, having that fully settled amount, fair market value of property before, after, just noting that it's not necessarily zero, even if completely destroyed, as you said earlier, because the land remains. What to know about reporting. So gain on contents per personal property. If there's a gain, then there is a requirement that the property be replaced, like you said earlier, to avoid tax, and there is a tax reporting disclosure requirement. If reimbursements for business property or personal residence are not received until the year following the disaster in a gain situation, and there is no intention to reinvest, right? Like you said, repair, replace that item, rebuild, replace that item. You need to report in the year the reimbursement is received,
Right.
because you're not deferring past that point if you're not reinvesting it that way.
Correct.
All right, now here we go. Do I have an involuntary conversion gain? The bullets are, it's very possible, especially if your home was purchased many years ago and values have risen. You can have a gain even if underinsured. And then there are ways you can reduce that taxable gain while following the regulations. And speaking of that, how do you defer it? So an involuntary conversion gain may occur if the payments reimbursements exceed the cost basis of the property. For personal primary residence, it may be possible to utilize an exclusion to offset the gain under sale of personal residence rules. This is IRC section 121. And this is what you were talking about earlier, John. It is possible to defer the gain if reimbursements are reinvested in either rebuilding the home or acquiring replacement home or homes within 2 years. And that 2 years is not from the catastrophic event, but the end of the first year that you first realize a gain.
Correct.
All right.
Should I talk about the 121 a little bit?
Yes, that's my next slide. I'm just going to be
Okay.
quiet now. You've got it.
Okay. Okay. So one of the exclusions that is available on these situations, whether it's a disaster or not a disaster, is that the law looks at the transaction as you have sold your house, or in this case, you've sold the ashes maybe to the insurance company. And that entitles you to claim this $250,000 per person or $500,000 for a married couple exclusion of gain, up to that amount of exclusion for, of gain in these situations. Additionally, well, the normal situation to claim that is that you need to have owned the property for at least 2 years. You have not used the exclusion for at least 2 years, and you've lived in the property for at least 2 out of the last 5 years. Now, let's say that you bought the property exactly 1 year before the fire. Well, in that case, that's less than 2 years. You bought it, you owned it, and you probably, maybe if you used the exclusion on a prior residence. So geez, it sounds like on three counts you're out of the game. Because this is, quote, an unforeseen circumstance, unquote, we get to prorate the exclusion. So if you lived in the house exactly a year before the fire, then that would be 50% of 2 years. So a married couple could claim 50% of the $500,000 exclusion and claim $250,000 exclusion. Also, if the house was insured reasonably well and bought only a year previously, the cost basis is going to be relatively high probably, and the insurance might still get a gain, but it's possible that $250,000 in my example might cover the gain and eliminate it. Earlier, I mentioned a situation. I created an example where cost basis was $300,000 and the taxpayer received $800,000 from the insurance company. So there's a $500,000 gain. Well, if they if they lived in the house for the 2 years, met all those requirements, and were able to get the $500,000 exclusion, then that $500,000 exclusion would eliminate 100% of the gain. If, on the other hand, they had a cost basis of $300,000 and they got $1 million from the insurance company, then they've got a $700,000 gain, but deducting the $500,000 brings the gain down to $200,000. We deduct the $500,000 from the $1 million of proceeds, and the amount that required to be reinvested to avoid defer taxes on that $200,000 would be $500,000. The $1 million, $1 million less than $500,000. So I think that covers it. Unless you think I need to say something else, Val?
No, I think you're good. Thank you.
Okay.
Keep going. All right. And then I think you've already alluded to this. How long do you have to replace property on involuntary conversion gain? Deadline is 2 years. Extensions may be available, must be filed. And as you said, it's from the date the gain is realized.
Yes, and I want to emphasize the 2 years, because if it was a declared disaster, then that 2-year period becomes 4 years. That's not available with the park and mountain fire. We are limited to only 2 years. And again, as Val said, the 2 years is 2 years after the end of the first year in which a gain is realized. So it's possible that maybe you didn't collect all your insurance in 2024, and you're collecting some more in 2025, finishing up, settling up with the insurance company. And maybe in 2024, with the $500,000 exclusion, you don't have a gain. But then in 2025, you get some more insurance proceeds that cumulatively puts you in a gain position. Well, then in that case, you have 2 years from the end of 2025 to complete the replacement. And again, if you running up against a time roadblock at the end of 2027, it is possible to get extensions, and the IRS does provide give those extensions 1 year at a time. There is an application process to getting that extension, and but they are, if the documentation for the extension is adequate, they fairly easily give those out. They have been the last few years, they have been a little delayed in terms of getting those out. Last year, I didn't get some of the extensions approved until September of 2024. But I was pretty confident that I was going to get them, but we still had to wait until we got them in time to file the returns by October 15th. But the IRS is, I think they've just been inundated with all the losses the last several years. And also a couple of years ago, there was a change in, there's been changes in personnel of the people handling these applications. But they are knowledgeable.
All right, thank you. And speaking of knowledgeable, so for people who are not looking to rebuild, can they buy multiple properties to offset that involuntary conversion gain?
There's no limitation on the number of replacement properties that you can have. So you could rebuild the burned home, and you have money for, hopefully in some cases you might have, maybe you're not building quite the same size house that you had before, and you got money left over. Well, you can go out and buy another personal use piece of real property. It has to be personal use. or you sell the lot. And we haven't talked enough about the sale of the lot, but
Next
just,
slide.
okay, well, I'll wait then to talk about the sale of the lot until we get to the next slide.
All right, but also, one of the bullets is must be similar or related. Any personal use real estate generally qualifies.
That's
Uh,
right. Now,
and then it,
if it's rental property, then it has to be, then the replacement property has to be rental property. I don't know that we have any commercial, were there any commercial property losses in
I don't think so,
yeah, so
but
I
if
won't get
they
into
are,
that.
please put it in the chat. Yeah, if
Yeah,
they, I'm sorry, put it in the Q&A. Yeah.
yeah.
Um, an acquisition of replacement contents doesn't necessarily have to be identical. It also counts. The one caution is, like you said earlier, the replacement period time limits must be followed or formally extended.
Right.
And all right, now if you sell your lot, will the proceeds be taxable? And
Well, the situation with the sale of the lot is that if presumably you're selling the lot because it's just not economically viable to rebuild, or you just decided you don't want to rebuild and you need to move away and start all over again for whatever reason. It is possible to take those net proceeds, uh, the the net, well, when I say net proceeds, I'm talking about the sale of the lot amount less the closing costs. Take that net amount and add that to the insurance proceeds, which maybe will use up some more of the $500,000 exclusion that you haven't used or not. And there is a limitation on this that's an important date to be cognizant of. And that is that if you sell the lot, in any case, it can be added to your involuntary conversion calculation. But in terms of this proceeds from the sale of the lot being included in the calculation of the $500,000 exclusion, the sale of the lot must close within 2 years of the date of the fire, not the end of the year, but the date of the fire. So if it closes 27 months after the fire, then that sale does not qualify for the being included in any calculation for the $500,000 exclusion, which you may have already used up just in the proceeds from the insurance. But if there are proceeds, if there is the $500,000 exclusion that's left over, and you're thinking about selling the lot, you want to make sure that you sell it within that 2 year period after the date of the fire.
all right, and now we're going to talk about reporting an involuntary conversion deferred gain. So reporting is required annually, detailing the overall and current status of the reimbursement process, the replacement reinvestment process, as well as other data and information. Accuracy and completeness is key to communicating with the IRS and state tax offices in order to meet all requirements. Again, a reminder, no pre-printed form is provided by the IRS. Reports are part of the regular income tax return and are included starting the year of the loss. So for folks filing their 2024, the return, that would be, they're going to start the reporting and end upon completion of the replacement process. Now, John, with the fact that California law gives you up to 36 months and the rebuilding process might take longer and let you run the full 36 months after disaster, um, how does that play out? Because some people might not settle their insurance until they finish rebuilding, and that would put them literally, fires, I mean, the end of 2024, so the end of 2027, beginning of 2028?
Could happen, and you may need to request an extension of the replacement period with the IRS.
Okay.
But in any case, these reports And they're just a document that gets attached to the tax return. There's no line on the tax return where you put a number or anything like that. It's just a document that's part of the filing, but and the document is referred to in the tax return just to say that, you know, we had a loss. We are reporting an involuntary conversion and see the attached document. And each year that document gets updated. That's the episodic aspect of the reporting. There's each year's an episode or a chapter in the overall process of your recovery. And so you'll have, if you complete the recovery by the end of, say, 2026, you'll have reports for 2024, 2025, and 2026, each one getting attached to the tax return. And
Right.
the information will be current, the current information, what happened during the year, plus a cumulative tally of what's going on.
All right, thank you. All right, John, I'll get you to catch your breath here for a minute.
You can drink the water.
Yes, I'll wet your whistle here. All right, and we're going to move into some of the other considerations, and these are just light touches, just to touch on some of those common circumstances people might be facing, and just at a high level, just give a little orientation about what to look for. So really, it just depends on your circumstances. Did you have a rental property? Was this a second home? We've talked about number of replacement properties, how that works. Did you have a trust? If there's a lawsuit, what are you doing? Divorce or a death, change of use, business loss, taxes. These are some of the circumstances that you might be looking at. And we're going to start with tax treatment of funds for that additional living expense. They are not taxable to the extent they are used towards actual temporary additional living costs. And these are expenses incurred after the event, not part of the disaster itself. They're not part of any casualty loss calculations. If you have excess funds, say they paid you fair market value for a year, right? And you move back in, and so you have $10,000 you didn't spend because you moved back home. You're not incurring those additional living costs. That $10,000 would be taxable because you didn't actually use it for those extra costs. However, those out-of-pocket payments for ALE that insurance did not cover are not deductible, right?
No, but they can be used
To
if
offset.
to offset maybe some of that $10,000.
Got it. All right. And then we're going into, if you use your additional living expense to purchase that capital asset, that real property, replace a temporary home, right? Or an RV, something that's real property. It results in a substantial portion of ALE proceeds becoming taxable. Now you could treat your temporary residence as part of your replacement property to spread that deferred gain over more properties. And so if you resided in it for at least 2 years and sell it to move into the permanent home, you can apply that exclusion that we talked about, the $500,000 exclusion, eliminating that deferred gain. But just to be aware of, once you move into that capital asset you purchase as a temporary resident, you're no longer incurring temporary living costs since you're living in that capital asset. So whatever is left over becomes taxable at that point most of the time. And then, John, one of the questions, and I see a lot of people trying to figure out, can they do this? What if they lease or have a purchase agreement or buy a temporary home through their business and lease it to themselves? What does that do?
Well, it shifts the gain.
Okay. All right, legal litigation proceeds. So if there was a claimant that you could go after for causing the casualty, it's just to be aware, these are complex, take years for these actions to play out to the final income. The things to be aware of, Non-physical injury claims that align with real property should be treated in the same manner as insurance proceeds, so could be considered taxable. It goes into your calculations. Emotional distress, personal loss of income are taxable. Compensation for medical care and bodily injury are not. And then rental property loss of income, you can deduct the legal fees as ordinary necessary business expense, just like you would mortgage interest. And then is the reporting for business related losses different than your personal property? And so there is a different standard for qualified replacement property for business losses. The gain on involuntary conversion calculations is similar to personal property with the following differences. The land is not included unless it's sold to it no longer being economically viable. Loss must be substantiated similar to individual losses. You're providing an inventory, and that cost basis, like you said earlier, it's going to be based on your depreciation schedule computed up through the date of your event. So you should have in your previous tax records that depreciation schedule up until the current year's tax return, right? Anything to
Right.
add there?
Well, again, the concentrating on the rental property, because we probably don't have any business losses. The cost basis, we're not including the land, so right away you have a potential for a gain, a bigger potential for a gain. If you've held the property for any period, any substantial period of time, the real property has been depreciated, so that reduces your cost basis, increasing the the chance for having a gain that needs to be deferred. And the replacement is either rebuilding that rental property and re-renting it, or going out and buying another piece of rental property. If you do not sell the old lot and you buy a new piece of rental property, the only costs that are allowed in terms of saying, checking to see whether or not you've met the reinvestment requirement, is the cost of the improvement. So you're looking and saying, I had a rental property and I had land cost on that. I still own that land, and now I'm buying this new piece of rental property. For purposes of reporting the acquisition of replacement property, we would have to eliminate the land costs from that replacement property. Now, if during the replacement period you sell the old lot, then once that lot is sold, the proceeds then would get added to the proceeds for the insurance in terms of figuring out your deferral, et cetera. But then also the acquisition of the land cost on the acquired property then gets triggered and gets included as part of the acquisition cost of the replacement property. It sounds complicated. It's kind of straightforward in reality.
All right, John. And while we're talking about rental properties, just a reminder to folks, they're considered investment property. There is no loss of rental income, so you're not paying taxes on the rental income you didn't receive. If it
Right.
was not insured, most likely that's one of those instances where you might have a casualty loss if you were not insured for your rental property.
Or
Um,
or you could have a casualty loss if you're underinsured and maybe you don't have a lot of depreciation, and it is possible to have a casualty loss.
All right, thank you. And then I'm going to pop back to for the business involuntary conversion, can you defer that gain? So, and the bullets are, if the gain results from proceeds in excess of the cost basis for your business, treat the reimbursements as proceeds to be reinvested. You have 2 years after realizing the gain to reinvest or use in repairs, rebuilding the damaged, destroyed property.
Yeah, the critical thing with the business losses where we do not have a disaster declaration is that the replacement property standard is similar or related in service or use. So if you had an ice cream shop that was lost in the fire, and you decide, hey, I really don't want to be in the ice cream business anymore. I'd really like to have a card shop. Card shop is not qualified replacement property because you've lost an ice cream shop. You must replace it with another ice cream shop, unfortunately.
All right, thank you. Now we're going to talk a little bit at a high level about tax implications from losing a second home. So reporting for a vacation second home is exactly the same for these two fires as a primary personal home. And again, you're combining the land, landscaping, building improvements, building itself, all one integral unit, one number.
Right.
And we've done the rental property, and here we go. Do I need professional help? Adhering to time limits, allowances established by the tax code, and reporting are extremely important to protect your resources. Failing to report a tax loss event on a tax return could avoid in totally avoidable penalties and loss of valuable tax opportunities. The reality is it's very difficult to correctly calculate and successfully claim a casualty loss. Reporting an involuntary conversion is even more difficult. Changing rules and complexity make it wise to seek advice from a qualified vetted professional. So just throwing that out there. And I know the question always comes up, John, of how do I find someone who knows how to do this?
Uh, it's tough. It's tough. The reality is that most accountants could go through a whole career without having to deal with any one of these, with any of these types of situations. And those accountants that are faced with having to deal with one of these situations, they may have one client that they're dealing with, and that becomes a lot of research and stuff that the accountant is not likely to want to be able to spend the time doing for just one client. And so it's good to find somebody who has experience in dealing with these events.
Right. And definitely reaching out to previous disaster survivors, like from the Thomas fire and the Woolsey fire. There's folks there that would have had CPAs who had to do the homework for them. So asking for those referrals would be helpful. Reaching out to the long-term recovery group to see if you can connect with some of those survivors to find out who they use. All right, deep breath, John. We're on the home stretch here. Reminder to everyone, if you have any questions, please put them in the Q&A. Reminder to stay informed, sign up to get our emails of future events and updates. Like I said, we'll be doing a workshop on the contents claim process in March. The date will be, that information will be emailed out soon on Constant Contact. And that will be for Mountain Fire, that will be an in-person live event. For Park, that will be a recording, and you'll get that information by the Constant Contact we send out. Our slides will, in the video link, the recording will be available both on the event side, or you can email info at. We have our Survivor to Survivor forum. It's just a really good resource for emotional support and problem solving in real time with those previous catastrophic loss survivors who've been there, done that, and are willing to share what they know to help you shorten that learning curve. Remember, if you're having an insurance claim issue, one of your first resources available to you is the California Department of Insurance. You can file a request for assistance online, by paper, or calling them. Please take advantage of that. And if you have issues with insurer and you need to report issues, please take advantage of that resource. Upcoming Roadmap to Recovery events. You can see the information here for Park. It'll be online February 26th, and Mountain will be in person. As soon as we get those details confirmed, we will share that information with you. Our Ask an Expert forum is open. And please take advantage of that to get individualized answers to your questions. And then we'd like to thank our funders for allowing us to do this work. And thank you for giving us time today. And John, thank you and Amy both for supporting us in this today. And I will check and see if we have any questions in the Q&A. And if not, we'll give people just a minute. I appreciate so much your time today, John, to get us through this.
My pleasure.
All right. And I think we're good. Thank you all. Have a good evening.